Well, good morning, everyone. Thank you for joining the M&A Getting Your Plans Back on Track panel. My name is John Reale. I am an audit senior manager at BKD here in Dallas, and I will be serving as your moderator here this morning. For those of you that don't know BKD, we are a national CPA firm. We specialize in audit, tax, advisory, consulting services. On behalf of the Entrepreneurship Institute, obviously, we'd like to thank you again for joining today's session. We hope you're enjoying the content this far. With that said, I'll go ahead and introduce our panelists. Andrew, I'll go ahead and start with you.
Good morning, everyone. I'm Andrew Kinworthy. I'm a shareholder with Polsinelli. I practice in the corporate and transactional practice group. Polsinelli is an AmLaw 100 firm with over 900 attorneys nationwide. We're a full service law firm, so we do everything from M&A to litigation, real estate, healthcare, tax, labor and employment, and everything in between. I practice out of our Dallas office. We've got about 50 or 55 lawyers here in Dallas, and excited to be with everyone this morning.
Thank you, sir. Russell, you want to go ahead and go next?
Sure. My name is Russell Naisbitt. I'm the Houston practice manager for VCFO. VCFO, as the name implies, is a financial consulting company providing the services of CFOs, controllers, and HR specialists. We also have a recruiting practice because we're always looking to recruit for ourselves. We also recruit on behalf of clients, mainly in the areas of finance and HR, but not exclusively. We do fill other C-suite positions as well.
Awesome. Thanks, sir. Matt?
Hey, good morning. My name is Matt Klauser. So I am a partner on the transaction services team at BKD. So work with John, spend all of my time either helping clients buy other companies or prepare their own company for sale.
Thank you. And David?
Hi, I'm David Robson. I am an acting CFO. I've been a public company CFO, private equity CFO, and done a lot of M&A, which is why I was interested to help participate in the panel. And I'm also a board member of 2 technology businesses in the SaaS space.
Perfect. Well, with that said, today's goal is to kind of update everyone here with kind of the M&A landscape and what you guys are seeing thus far. So I guess the first question I'll ask all of you is kind of what are you seeing right now in the current M&A landscape, and really what are you guys seeing in the marketplace? And we can kind of go in the same order we did as introductions, if that works.
Thanks, John. So I think it goes without saying, things have changed dramatically in 2020 from where we were last year, not just in terms of M&A, but in all aspects of life. Once the shutdown hit in the spring, M&A slowed down dramatically. There's just so many issues, that buyers and sellers on both sides had to think through and deal with, many of which none of us have ever seen before. So understandably, M&A came to a grinding halt for a few months. Once things opened back up, we've seen a lot of what I would say is pent up demand for deal activity. And that started probably sometime in the summer and has accelerated as we've moved towards the end of the year for various reasons, not the least of which being, potential new administration coming in with a stated goal of increasing taxes and specifically the capital gains rate. So we're seeing a lot of activity right now in M&A, a lot of interested parties in getting deals to the finish line before December 31st. And I think we'll get into some more of the detail around, some of the specific changes we've seen in deal terms and the like as we get further into the presentation today.
So my anecdotal experience kind of mirrors Andrew's, and we're now seeing basically a resumption of activity at former levels. There's obviously an added layer of caution around COVID. The impact of COVID on both buyer and sellers businesses is adding complexity to the way they look at deals. But there's plenty of dry powder out there looking to be put to work. I've got clients that have received inbound inquiries regarding potential acquisition interest. So I think we're close to being back to normal with the proviso that due diligence is going to be extended to take into account impacts of COVID on both sides.
Yeah, Russ, I mean, I won't repeat anything. I'll just touch briefly on, the kind of the swing that we saw. So for us, from a transaction volume perspective, April and May were non-existent. June add-on transactions started getting done for us. July, August, we started to see platforms pick back up. And so now those deals are getting closed. So we'll touch on a lot, but just what we're seeing in the marketplace. The activity is back, and we'll talk through a lot of things though on people rushing to the finish line for this year and valuation as we go through.
Yeah, the only thing I would add, and it is a bit anecdotal, which is the deals that are going under QOV work and due diligence, it's very hard to get them to close because a lot of this is still remote. And a lot of buyers are tentative to really seal the deal until they can look under the hood physically and touch the business. And so that's also going to have a lasting effect for a while of creating deal inertia that's going the wrong way to get these over the hump.
Perfect. Yeah, and one thing I want to add before we continue as well is obviously we want to keep this as interactive as possible. So if any of you have any questions, please feel free to send those in and we can address those as soon as possible. Andrew, I'll kick it off with you with our first question here. What have you seen? Obviously, we've touched on it briefly, but what are the impact COVID's having on the due diligence process?
Yeah. Good question. The impact COVID has impacted all aspects of diligence, legal, financial, operational, and really just the process itself was dramatically impacted, certainly with the shutdown, not being able to travel or access people. It was just it's dramatically different now than what it was. The fundamental things, just accessing the management team, the owners of the business, being able to get in person with them is different now than it was 9 months ago. There's ways around those issues. Zoom, obviously everybody's using that now. That's a very handy tool to be able to have like your management meetings and presentations. But in terms of, what people are used to doing, which is, meeting in person, kicking the tires, touring facilities, a lot of that's become challenging now as part of the diligence process. And then, from a legal standpoint, as part of the legal diligence, one issue that's now come up with COVID is what's the impact on a target company's customers and suppliers. So you've got to be concerned not only with the business that you're looking at buying, but how are their customers, how are their suppliers handling COVID? What's the impact on them? Are they extending the amount of time it takes to pay their bills? Are they having to reshuffle because of revenue and cash flow issues? And is that flowing through to the target company? There could be contractual aspects to that. If you look at, have there been breaches of contracts with customers and suppliers. You know, force majeure has been talked about and written about extensively over the last 6 to 9 months. You know, is that something that's occurring within the target business that you're looking at? You know, is the continuity of your business relationships going into the future, is that impacted? You know, are there major customers or suppliers that aren't going to be there? They're going to be bankrupt or their business goes under. All of that is now, you know, new aspects to the diligence process that has to be analyzed, thought through. And I would just recommend, you know, anybody that's thinking of going through a process, either on the buy side or sell side, make sure you have a good a team of advisors behind you, you know, both on the financial accounting side, the legal side, maybe even the operational side, so that you can get, you know, a lot of expertise in helping get your hand around some of these issues that we're seeing now today in the M&A environment.
Perfect. We just got a question from Steve asking kind of what industry sectors are more active than others. So I'll open that up to the 4 of you to kind of respond to that.
So I'll jump in on that. So a good, as with David, a good chunk of my client base is in the tech space, mainly medical related SaaS software companies. And I would say that that's a particularly hot space right now. There was a pause when COVID hit, but the activity, if anything, has come back stronger. I think a lot of those businesses have pivoted and adapted to COVID, and actually are in a stronger position today than they were because of the pandemic. It's helped accelerate the development of their businesses, and there's a lot of M&A activities, particularly in healthcare, around remote patient monitoring, home health monitoring, that kind of stuff. That's of interest to both financial buyers, private equity groups, as well as strategics.
Yeah, I would add to that. I've seen the same thing just because I'm familiar with the space, that, you know, certain medical and healthcare technology businesses, and we're also seeing transformative digital businesses, there's a high degree of interest and a premium being paid. And, you know, we're on Zoom right now. There's a lot of video conferencing tech and telecom businesses that are in high demand. So the digital space that allows for remote business is an area that I think is going to continue to have a lot of demand.
Yeah, I would touch briefly. So healthcare has been an area we've seen a ton of deal flow. I think, you know, I think a lot of buyers are trying to not buy, you know, something that may have just hit because of COVID that could be on its peak right now. So healthcare is always going to be there for them. But there's a lot surrounding the clinical trials industry as well, with, you know, COVID just maybe re-emphasize that to everybody. But you know, we see CROs and almost anybody who helps the biopharma industry get their drugs through trials into market faster is spurring a lot of interest right now.
Okay, I'll go with our next question here, and Matt, this one will be for you. How are COVID purchase price adjustments affecting kind of current deals you're seeing, and how are companies kind of leveraging and maximizing their value when they're selling?
Yeah, so we're still working through this, is what I would say. That this is still real time because of the lag I mentioned, where there was a couple months where no deals were getting done. And then add-ons were getting done. And so the COVID adjustment it wasn't as important. It wasn't as big of a deal. So when somebody's doing a $100 million platform and a $10 million add-on, for example, it's a bigger deal on the $100 million deal, right? And so it took its time to kind of come to market here. But what I've seen on platforms lately, So I've got a couple healthcare and then a couple manufacturing that I have in mind. So 4 deals that have a quantified COVID adjustment in the quality of earnings. And that's both buy side and sell side. Really what I'm seeing is buyers are open to the idea. Buyers know they need to be open to the idea probably to get a deal done. Because if you look at the vast majority of financials over the last 6 months, they've trended down compared to where they were a year ago or to where they were the 6 months leading up, depending on whether you have seasonality. So buyers know they need to pay attention to COVID and give sellers some credit if you can already start to show that you've recovered and are coming out of it. So I think there's a lot of hesitation if you can't show that you've already started to recover a little bit. Buyers are probably going to be a little more patient. If you can, then there's some math you can do to quantify, like almost think of like a lost profits calculation if you had an insurance claim or something like that. That's kind of the mindset we enter it with. And so I've seen some of that quantified. We've looked at lost revenue. We've looked at, hey, were you able to cut some payroll? Did you have temporary workers or some hourly workers that you could cut? Did you cut marketing and travel and things like that? BKD's not going to trade shows and conferences anymore. We're all sitting right now today doing this. So you have to go all the way down the P&L to really understand what the impact was. And then what I've seen is once you quantify that, predominantly I've seen buyers have to absorb that out of their equity check. So if you're going to finance a deal, from my experience, and again, we're still new, lenders aren't jumping all over that saying, yep, okay, I'll lend some extra money to this deal. If they're doing, a certain multiple of EBITDA for the debt, they're not accepting the COVID add back, the lost profits add back. So it's shifting it and buyers are having to put in a little more equity if they want to get the deal done. That's what I've seen as of late.
Yeah, and you touched on multiples there briefly. So, my next question to you, David, is kind of where are current multiples in this environment, and kind of what are you seeing out there?
Well, a lot of what we already spoke to, it's really industry specific. I would first start with that. And second, we've already talked about that there's overall downward pressure on deals, which just by definition lowers pricing. It's a little bit dated, but everything's dated in real time. But it was a few months ago, Harvard Business School put out a study on deal activity. And it's, again, the same thing we've talked about. Deal activity is down. When deal activity is down, then pricing are going down. So you're going to see a lot of variety. I'm not going to give you numbers, but it's industry specific, and there's premiums out there. But overall pricing is down because there's just less deal flow.
And next question here is, Russell, as far as transaction readiness, how can it help, people get ready to get their business ready for sale?
So I think being transaction ready is incredibly important. And with my clients, I try to encourage them to always be transaction ready. So they're adopting best practices from the moment they start their business, and they are, if they're building the business with the intention of an exit, which when it comes to the medical software companies is, they all have that as one of their goals. And so it's never too soon to get the business transaction ready. And if you're looking to exit in the next year or two, now is the time to start. And what that means is getting your financials in order. So your financial statements need to be compliant with GAAP, generally accepted accounting policies. You need to consider whether it would be worth getting your financials audited, depending on the size of the business. That may or may not be a value enhancer. You need to look at opportunities to groom your overhead expenses with a view to maximizing your EBITDA at the desired point of exit, because and for traditional businesses at least, a multiple of EBITDA is still the kind of the main criteria for valuing a business. If you're a SaaS software company, it's more likely to be a multiple of your ARR, your annual recurring revenue. So look at how you can juice that to get it to a place where you can, applying an industry standard multiple, you can get the desired exit price. Making sure you have all your legal affairs in order, that you've done audits on your software to make sure that you're not using any third-party software that could lead to an infringement issue. Making sure all of your HR practices are best of breed, that you have all your handbooks in place, that your record keeping is compliant. All of these things, just from going through every department of your business and making sure that your business is ready for some pretty intense scrutiny, and every aspect of it is important. And ideally, you'd want to start that. I just emphasize this again. You want to start that process a year before you're planning on selling at a minimum.
We just had a question come in from Valerie, and that question is, how are buyers ascertaining what the future of the company's market or markets is going forward? I don't know if any of you four would like to touch on that here briefly.
I'll give a real life example. We're doing a buy side on a platform right now that has several end markets, and it's private equity buyer. And so they just told me this week, they sent me an industry report that they're looking at from one of their service providers that they know and trust. So probably every service provider on this line has sent you guys some, thoughtware or whatever that provider calls it, about trends that they're seeing in the industry. The private equity group kind of solicited an industry report to see what was going on specifically in those end markets. So, for example, this company manufactures a product that ends up in the protein market specifically. And so our buyer was getting their arms around both, one, how the last 6 months have been impacted, so that they can try to ascertain, how much of the downside was COVID and how much of it was just maybe the business went down. That's an important factor. And then they're trying to get their arms around what it looks like going forward. So I think there's plenty of unknowns there, but especially when you get to the professional investors, there's a lot of rigor and a lot of process that they go through to make sure they know what's going on in the industry. And most of them have industry veterans on their payroll as well, who can give them insights like that.
Yeah, I'd just say that I'm also seeing with a deal that is in progress right now. It's a fairly large deal. It'll probably go in the $350 to $450 million range. And the investment bank that we're working with has requested that industry study as part of the preparation to take the company to market. And the expectation is that the buyer will want that study done. The question is whether they will accept a study that's done, by the sellers or at the behest of the seller. But it's still worth getting it done so that there are no surprises, when that topic comes up in due diligence.
Thank you, guys. I'll move on to the next question here. Andrew, this one's for you. Kind of what are COVID's impacts on reps and warranties, indemnification, and other purchase agreement terms? What are you seeing out there right now?
Yeah, I think it's similar to diligence. No one's ignoring the impact of COVID in drafting their definitive agreements and putting the specific deal terms on paper. So the environment we're in now, you're seeing substantially different deal terms than where we were 12 months ago. In reps and warranties, you're seeing, I guess let me step back and just say for any, business owners that haven't gone through an M&A process before, reps and warranties can be a kind of a foreign concept. So maybe it helps to kind of explain what those are. So every buyer is going to want to have the seller make certain statements, certain what we call representations and warranties about the business that cover operational matters like customer contracts, vendor contracts, and also cover compliance with laws and legal aspects of the business, making sure that what the buyer is coming in and purchasing doesn't have a bunch of liabilities associated with it. They're going to cause the investment to lose value, right after the closing. So that's sort of at a high level what reps and warranties are. What we're seeing in this market is new reps and warranties coming into play that deal with, COVID, the pandemic, and some of the, impacts that it's having. So, we have reps and warranties that no one would have thought of 12 months ago that are now going into purchase agreements because of COVID and the pandemic. One specific example of that is the CARES Act that was passed this spring. There was a lot of businesses that got PPP loans. There may be probably most of the people on this call are familiar with that process and trying to obtain those funds. Now that that money's most likely been spent, a lot of people are looking at, can I get those PPP loans forgiven? Do I have to repay them? And if you're going through an M&A transaction in the midst of that, that's an issue that has to be dealt with. It involves your lender, your bank. It involves the SBA. But if you're going through an M&A transaction, that's something that needs to be dealt with as part of that process. And we're seeing that, play out in real time because, this is a new program. The SBA didn't really have a process in place before this for, approving a lot of forgiveness applications. So there's a lot of sort of learning as you go in terms of how this process is going to work and how the forgiveness of those PPP loans is going to work. And then, of course, indemnification, which flows into the reps and warranties, is the buyer's method of trying to protect against liabilities and potential risks after the closing. Those terms have swung more towards being buyer friendly, whereas pre-COVID, everything was very seller friendly. The M&A market was hot, and in order to get deals done, buyers had to give a lot on the terms of the indemnification package that they were proposing. That changed dramatically in the spring with the pandemic raging. I think things are starting to shift back to maybe neutral or shifting towards sellers in terms of the indemnification terms. But there's still a lot of uncertainty that buyers are worried about, and rightfully so. And so I think especially the more risk averse buyers are going to continue to try to get as much protection as they can through their indemnification package and the definitive agreements. So we'll see where that goes from here, but I think a lot of that depends on if the economy continues to improve and the M&A market continues to improve.
Perfect. So next, we're going to kind of take a step back kind of from COVID and just talk really generally about M&A process as a whole. And again, I encourage anyone, if you guys have any questions, please enter them into the chat and we'll do our best to get those answered. Matt, as far as sell side due diligence, kind of, from a seller's perspective, how do I maximize valuation on the sale of my business? What can you elaborate on there?
Yeah, I'll first say nothing replaces having a well-run business, right? So I know a lot of times advisors like ourselves are going to tell you all the things you can do to make it incrementally better, and we can help with that. But I don't want to pretend to even say, well, this is all you need to do. This is just what we know how to help you do to improve value. You running your business and making sure that that you continue to grow and focus on the business and don't take your eye off of it when you're going through a transaction is something that you need to pay attention to. And that it's just coming from, I've seen a lot of deals die in diligence where the owner was basically a one-man or one-woman shop, maybe had one support person, but didn't go out and get advisors to help them. They tried to do it all themselves, and they ran out of time. Well, then sales growth stopped coming in because the marketing wasn't being done and things like that. So I would say, my best advice to you, this is like when my wife and I think about selling our house, frankly, and honestly, I relate a lot of selling a company to selling a house. So this may not be the last time you hear the example, but we had a condo in a downtown metropolitan area before, and she asked me, hey, do you want to lease it instead of sell it? It wasn't that long after the housing crash in '08. And my response was, that's not my day job. I don't want to be a landlord. That's not what I do for a living. I know how to make money doing deals, not being a landlord. And so I take that at heart, though, to the business owners today and say, you're likely very good at running your business. The best thing you can do is focus on your day job and let people whose day job it is to help you get deals done add that incremental value. And so Russell kind of already walked through that. I won't repeat that, but I'll continue to say, hey, when you sell a house, I still don't do it without a realtor. Some people do, but I don't, because I don't want the extra work. And so I understand that I have to pay a commission to my realtor to help get the house sold, but I view it as cost benefit favorably. So, I think don't try to extend yourself and do too much yourself. The real way to maximize value is to make sure that you are as locked down and prepared as you can going in, that you have somebody there talking to you really about multiples that are going on in your industry, not somebody that you golf with who told you what their company sold for 5 years ago. That's not going to help you maximize your value. And that you've really thought through the process and have everything cleaned up. So we could spend a whole hour on exact things that you do, but if I boiled it down, I'd say focus on your day job and get prepared with the team around you to help you go to market.
Yeah, definitely. Those are great points. Kind of on that point, David, this question's for you. And again, from the terms, from the perspective of a seller, who do I need to involve from management kind of on the M&A team when you're going through that process?
It's a good question. I think a lot of times businesses make a mistake. They think about it too narrowly, which is they say, who do we need? We need some financial experts, and maybe we need some legal people. You actually need a broader cross-section. The finance team may be the quarterback, but you're going to need the operators, both on, and you asked from the sell side, but both on the sell side and the buy side. The operators have to be engaged. The marketing folks have to be engaged. The sales people need to be engaged, because the sale process is a long one, and people need to be involved. The buyer's going to do a lot of due diligence on it, so the sellers need to be prepared on what they need to answer and how they need to answer it. I do think, and you didn't ask it, I do think it's more involved on the buy side, because you have to think who's going to be running that business after we buy it. If it's just something you're going to bolt on and not integrate it, it's a different answer, but generally you want to integrate it. So the salespeople are going to be working with that business post-integration. The marketing folks will be, the operators will be. It's not just the finance team. So it's worked well for me when you have a broad cross section. And the other thing I would always advise is assume you have two jobs. You have your day job to run your business, and we're already really busy, especially in the world of COVID. Now you have to add on this, as if you don't do it, you're going to have a failed process.
Yeah, definitely great points. And we'll come back to integration here shortly. But I guess for now, let's bounce back to kind of valuations. And Andrew, this next question's for you. And what are some ways to bridge the valuation gap between buyers and sellers, whether that's earnouts, seller notes, rollover equity? What are you seeing there?
Yeah, I think probably my fellow panelists would agree that one of the biggest issues with COVID is the valuation gap between buyers and sellers. Buyers are not wanting to, give up the higher prices, the higher multiples that we were seeing in 2019 and the first part of 2020. There's still that expectation that I need to get, full and fair value for my business. On the buyer side, so that's from the seller's perspective. On the buyer's perspective, they're saying, look at all these risks with the pandemic. We don't know what things are going to look like. We've got to build in some sort of discount into our pricing models, and we need to pay a lower price, maybe a lower multiple for this business than we would have, 12 months ago. And so there's a gap there between the buyer expectation and the seller expectation, who's still, maybe not willing at this point to give up a ton of value for what they see as a very healthy, thriving business. So there's ways to bridge that gap. You mentioned a few, John. The one that gets talked about a lot is an earnout, and what that is it puts a portion, and the exact amount of the earnout can vary relative to the overall purchase price, but it puts a portion of the purchase price in sort of a contingency post-closing, where, depending on the performance, the financial performance of the business after the closing, the seller can earn additional payments of purchase price after the closing. And usually that earnout period is 12 months. Sometimes it can be longer, 2 to 3 years. So it's a great way for the buyer to say, well, I'm not really taking on risk here, because if the business performs well, then we'll pay for it after the closing. That puts a lot of pressure and additional risk on the seller to sort of, stick around and have a vested interest in how the business performs after the closing, even if it's only for, a 12-month period. So they may be reluctant to put a large portion of the purchase price into that earnout. But at the same time, the buyer has a pretty decent argument that, hey, if your business is worth, this earnout amount, then, it'll prove it in the 12 months, after the closing, or whatever the earnout period happens to be. So it's a way to bridge that valuation gap, but there's a lot of risks involved. You've got to think about how you measure sort of your milestones. So is it going to be based on revenue? Is it going to be based on some measure of cash flow, like EBITDA? Is it going to be measured on something else? And that leaves some room for disagreement between the buyer and the seller. Once you get to the end of that earnout period, how do you measure the performance of that business? Accounting, and maybe, Matt and John, you can speak to this. Accounting isn't necessarily extremely precise when it comes to measuring the performance of a large business over a period of time. GAAP is a principled methodology, but it isn't always going to come up with the same answer every single time for different businesses. So there's a lot of room for potential disputes in using an earnout. In normal times, I tend to advise my clients not to pursue that, because there's just so much uncertainty and so much risk. But in our current environment, maybe it's a tool that could make sense in certain deals to bridge that valuation gap. And there's drafting tools that we have and that we can put in the purchase agreement to try to eliminate some of that uncertainty and some of that potential risk for disputes. in the future. And we can certainly, do our best to draft around that, but it's hard to completely eliminate it. But in today's environment, earnouts are just something that's very popular, and both buyers and sellers are talking about it, and are well served to kind of know what they are. And there's other mechanisms, tools we can use to try to bridge the valuation gap. There's seller notes, where the seller finances a portion of that purchase price, and the buyer pays the seller over time in the form of a note. That has sort of a risk shifting mechanism to it. And there's other tools as well. Rollover equity is a big one, especially for private equity firms. When they purchase a business, they typically want the sellers, the former owners, to roll some of their equity into the buyer entity, so that they continue to have a sort of a stake in the business. And the size of those rollover components in the terms of the overall purchase price and the consideration that the seller is receiving in the transaction, I think maybe is a little bit larger now than it was 12 months ago, because that's a mechanism for the buyer to keep the seller invested, to sort of bridge the valuation gap to a certain degree, because you're putting up less cash up front, and you're paying in the form of equity in the buyer entity going forward. So those are probably the three main ones that we're seeing. Certainly there's others, but if you're looking to sell in this market, you should definitely be aware of those those different types of structures for the purchase price that's being paid for the business.
Yeah, and I can echo those same comments from the audit side. I mean, every deal that we've worked on here in the past year or so has one of those three, earnouts, seller notes, rollover equity. I'd say 9 out of 10 deals have that. So it's definitely common. Russell, I want to hone in on quality of earnings and kind of just get your feedback there. Kind of, I guess, A, what are they? What are quality of earnings studies? And B, how can they help sell a company?
So a quality of earnings study, as the name implies, is kind of a deep dive into the financial statements of the business, and really looking to at the quality of them and the sustainability of them. So whereas an audit is conducted and with the goal of expressing an opinion on a set of financial statements, really saying that these financial statements fairly reflect the financial position of the business at this date and the results of its operations for the past year. They don't opine at all really on the underlying quality of the business. So the quality of earnings kind of takes it to the next level. So you're looking at breaking the revenue down to a customer level, looking at the retention metrics for those customers. If the business gets a customer, are they able to hold on to them? Do they grow over time? Do they shrink over time? That kind of thing. So looking at the momentum behind the revenue numbers, looking at the quality of the credits of those customers, looking at bad debt experience, all of that kind of thing in terms of the quality of revenue. Also looking in detail at the expenses for unusual trends and one-off items that might have either boosted earnings or had a negative impact on them. Either way, those items should be adjusted. Also looking at what might be around the corner in the future. If the company's enjoyed a long-term lease at a low rental, and that location is critical to its business, and it's about to about to be renewed to a market rate that, you know, could be substantially higher, obviously that's going to impact the future earnings of the business. So, so it's kind of a precursor to the financial due diligence, and really will also help a seller prior to entering into a transaction process by identifying holes in the business, things that could be addressed, weaknesses that need to either be remedied or that you need to be prepared to address in terms of the narrative around the sale of your business. So what we're seeing is that whereas maybe a few years ago, they were kind of not required and not as prevalent. Now we're seeing that sellers should be prepared to do a Q of E, and you know, in many cases, I'm recommending to my clients they get it done before they go into the process, so that it's not something that ends up holding up the process and producing surprises along the way that you might not necessarily be prepared to deal with. Typically, they're performed by a CPA firm that specializes in QOE. So, and the budget for it, you know, can be matched to the anticipated size of the deal. So the level of detail in the QOE can be, the scope can be tweaked so that it's, you know, reasonable in terms of the anticipated deal size.
And David, I'll kind of send this your way as well. So, you know, and as far as the Q of E studies, how do I perform a realistic or effective Q of E analysis?
Well, and I'll go back to both something Andrew and Russell said. When you do Q of E, you really have to look at not the lens of the business and the accounting that you buy, but what it's going to look like when you put it in your business. So as Andrew mentioned, GAAP is different. It's in the eye of the beholder. So how are you going to record those transactions as if you were to run it, because you're going to be the owner? And you may take a completely different point of view, and that will impact the quality of the earnings. The other view is, how do you think about risk? How do you enter into agreements? How do you think about expense management? What are your insurance policies like? What are your employee rules and regulations like? All those things will go into play that will say the earnings that they're showing you are going to be different when you fold them into your business. So whether or not you hire an expert, which you likely will to help you, you have to be fully knowledgeable on what it's going to look like when you own the business. And you're a lot more in depth than an expert to understanding how you do things in your house. And so you need to be part of that process when you evaluate the Q of E. And I think too many people fall prey, board members, senior executives, to allow the expert to present the Q of E from a very clinical point of view as they looked at the business based on their experience and based on other businesses. But you really need to plug that into your business. If I had owned it, what would it look like historically? And if I own it, what will it look like going forward? That's the true Q of E. And you may end up disagreeing with the seller because their Q of E in their world is perfectly right, but it's not going to operate. It will operate differently when you buy it.
Yeah, and I may just hop in, John, on that. So on that comment, like one of the things that comes up in a Q of E a lot is like pro forma synergies, which would cause buyers and sellers analysis to look different. And so, you know, okay, well, hey, if I'm going to go sell my company, here's the people that I have. For example, I've got my payroll, and that includes, you know, my salary, I have a CFO, I have an operations manager, all of that, right? Buyer may be sitting over there saying, well, I already have an operations manager, I don't need two. I already have a CFO, I don't need two. So that's going to become a negotiation between buyer and seller to say, well, who gets value for that? If you don't need my warehouse because you have your own warehouse and your own logistics team, can I cut those costs out of my P&L and increase my earnings and get paid more? Or does buyer get that because they're going to implement it? So I would just say there's no hard and fast rule there, but to that comment, it's important to be aware of things that are going to cause differences in them and, negotiate accordingly is what I would say.
Yeah, I think that's right. I mean, the awareness is the key thing. Then you're armed with good negotiation. I had a company that I was involved with that we bought a big sales structure that we brought on board, but after we integrated them into our business, they folded into our compensation plan and our commission structure that was different from the others. So right there, we have a difference of how we're going to think about it. That changes the economics. So you just need an awareness of it. So when you do negotiate, you have that in mind, as opposed to just looking at their numbers that the expert presented that says this is what they really made.
Yeah, awesome points there. On the topic of valuation, Matt, and this probably is more prevalent now than ever, but what criteria would you ascertain on the value of a business if the business isn't actually making any money?
So my pro forma comment that I just gave is going to be really relevant in that scenario. So I will say most financial buyers want some profitability in the business, right? Most financial buyers want some profitability in the business. But we get, a handful to several deals done a year where it's negative profits. There's got to be in that scenario a change agent basically that's going to flip that business because David was just saying, well, hey, it's buyers' quality of earnings that matters, not sellers. So maybe you're still in the ramp up phase and you just haven't quite gotten there, but buyer has confidence that a year or two down the road under a fixed cost structure, my revenues may double and all of a sudden we're spinning off cash flow and I can make sense of a deal under that scenario. Or maybe you've been pretty flat from a sales perspective, but it's back to my example that I gave. And we see this done all the time. Well, you have a huge operations team and a logistics team and a purchasing team, and you have a lot of things that duplicate what I have as well. And I don't typically see buyers give sellers all the credit for those. But as I mentioned, if they want to get a deal done and they think that the revenue and gross margin they're going to add from this business makes sense to them, they might start to share in some of those synergies so that they can get a deal done. Because if you think about the world and, we've got a couple guys with tech experience here. And so they'll tell you how deals trade on multiples of revenue and not EBITDA that the other deals we're talking about are. But obviously, a negative EBITDA times any multiple is not a good answer for you. So buyers are going to figure out ways how they can do exactly what David said, change the dynamic going forward. And then, they're going to have to figure out how much of that they're willing to give the seller credit for so that they can get a deal done.
Back on the topic of value, Russell, why is putting together the right deal team important to realizing maximum value for a business?
So, it comes down to the fact that most likely the people on the other side of the table from you are experienced in doing deals. They probably represent a private equity group or a strategic buyer that has a strategy of growing through acquisition. This is not their first rodeo. And if you don't have the people on your team with the same skills and experience, then you're likely to be outclassed. And there are a lot of pitfalls along the way to getting a deal done, and a lot of things that you could end up tripping over on if you don't have experienced people in your team. So I think it was mentioned before, you should have the legal and the financial are kind of obvious, but depending on what else is involved. There's intellectual property. You might want to have intellectual property. You might want to have a valuer. You want to have a tax. You want to understand the tax implications of your deal, and then you need to be fully informed in terms of the terms of the process. Oftentimes, like you see with this sellers, that they're focused on the price they can get for the business, but the terms of the deal are almost as important as the price. And I've seen this in where we're looking to not sell a business, but get funding for an early stage tech company. A VC once said to my client, I'll give you your price if you allow me to define the terms. You can have the price or the terms. You can't have both. And it's true also in selling your business that you need to pay as much attention to the terms as the headline price that you're getting for your business, or you may end up not getting the value that you think you're getting from it. And the way to achieve that is to have a team working with you who have done it before and understand all of the nuances of the deal process and the deal agreements, and can help get the best value for you at the end of the day.
Perfect. I see we have a couple questions roll in. We'll go ahead and go one more question, and then we'll open it up for the audience questions here. So, David, you touched on this earlier about integration, but what does a buyer need to consider when integrating an acquisition, and how do you retain talent post-acquisition?
Sure. Well, I'll touch on something Matt said, which is one, it's indicative on the deal and the degree of synergies. How much are you going to combine and integrate these businesses? My advice is understand what the end looks like and work backwards. What people, I think, always fail to recognize, and I said it earlier, this is something that maybe the board decided and finance does, but it is interwoven into the whole business depending on the degree of integration and synergies of the deal. So your technology, can you build a new customer effectively? Do you have the right systems and processes? Are your salespeople equipped to handle it? Who are you going to keep on from the team? Does your financial ERP system have the depth and horsepower to integrate it? So it's usually harder than you think, and it takes longer than you think, and it requires a really thoughtful planning process to do it. And generally, once the check is written and the deal is signed, everybody goes away, but that's really when the work just begins. So that would be one piece of advice. And another thing you want to think about is time works against you. The longer it takes, you have more potential to lose revenue and lose customers, lose suppliers. So you want to work reasonably quickly if you can. And in my experience, one thing that I've spent a lot of time doing up front is how much do I need the seller involved in my integration? And you can do TSAs and contracts to keep them in the game. You can have, we already talked a little bit about earnout or equity on the deal to keep them in the game, because you're going to likely need them for a period of time to transition. So in short, have a really good plan. Writing the check is the easiest part. It's the planning, and all the experts leave you after that, and you're stuck with it. So you got to understand how to do it.
Those are great points. So we had a question from the audience here from Dan. Given the current economic uncertainty, are any of you guys seeing buyers or sellers backing out of deals or delaying deals? And what are the short-term and long-term consequences of those decisions? So Andrew, you want to start us off there?
Yeah, great question. I mean, obviously when the shutdown hit back in the spring, there was a lot of that going on. A lot of buyers walked away, a lot of deals fell through. I think the main thing that I'm seeing right now in the M&A market is things are taking longer. due diligence is taking longer, negotiating is taking longer. Everything just seems to be proceeding on a slower timeline. And there's obviously good reasons for that, right? There's a lot of uncertainty. There's a lot of issues that buyers have to think through now that didn't exist 12 months ago. There's just a lot to think through as a buyer, and they're being more cautious, and timelines are just, extended. That's kind of what I'm seeing in the market. I think at least right now, there's less of deals falling apart, although that always happens. There's always a risk of that. But the timeline is just taking longer to get through the process and the different parts of the transaction process.
John, I would say we talked about PPP loans a little bit earlier. That is one factor. So let's say you get comfortable with all the transaction dynamics and are we going to give a COVID adjustment or not? Most sellers that I'm seeing right now have PPP loans on their balance sheet. And so there's very specific criteria. We have experts in the firm. I'm not them, so I won't pretend to play one. But making sure that we understand the forgiveness application and where the funds are, and they need to be in escrow for a deal and all those requirements. I guess you could use the word delay, but not like, oh, we're putting the deal on hold. It's just one of those things that I think Andrew was mentioning, that people need to make sure they follow through and understand that they're not going to walk into a $2 million PPP loan that they have to pay back. So there's nuances like that I think are adding some complexities right now.
Perfect. We have another question that come in from Valerie, and that question was, what greater value can be received when the seller is an owner?
Can you repeat that? You cut out at the last second.
Yeah, sure. The question was, what greater value can be received when the seller side has a seasoned negotiator instead of an emotional owner?
Boy, that's a hot question.
I'll start, guys. I mean, so I talked before about doing your day job, and I think that it's a very good question about keeping emotions out of it. Because if you ask me, one of the key things that kills deals, it's an emotional seller who just knows what their company is worth and won't listen to anybody else about any story other than what they have in their head. And I'll give you an example. We're working on a deal right now where I'm on the 4th iteration of doing a quality of earnings because the seller's gotten emotional. And every time that, hey, something didn't check out with how you told the buyer, seller flips out, for lack of a better word, and it creates a disconnect and the deal falls apart. And then, 6 months later, a buyer and seller come back together and they try to get the deal done. So to me, it's not as much about being the seasoned negotiator. I don't think you have to be trained in negotiation tactics by the FBI or anything, but you ought to have the right people who just manage deals, who know what they hear is not market, who know that companies in this home health industry aren't trading for these types of multiples, who know that it's not market to make seller pay for X in the purchase agreement. To me, it's just having deal knowledge on your team. But what I do like that the person asking the question hit on is check your emotions at the door. And that's what we have to do when we sell our house. You think it's the best house in the neighborhood, but check your emotions and just let the realtor handle the rest.
Yeah, I'd add to that too, before the emotional gets involved, is define what success looks like Does the seller really want to sell the business? What would be the terms he or she'd be willing to accept? And then, as Matt said, turn it over to the experts. Those I can achieve for you, or those I cannot. And if you define that, I think that can help when it does get in the heat of the moment, when, you know, they offend the seller for one reason or another.
Yeah, great points. Well, I know we are running out of time here, so I'll get everyone going to where they need to be. But again, thank you everyone for joining. Guys, thank you for your time and your knowledge and expertise. I know we have some great content ahead, so I don't know about y'all. I know we've got another breakout session, and I know we have Donnie Nelson speaking later, so that'll be exciting. I know the Mavericks are drafting tonight, so he's got a jam-packed day. But again, thank you for your time, and feel free to connect with any of us on LinkedIn or reach out personally if there's anything we can do to help. So that said, thank you everyone.